Welcome to the deep dive. So if you were watching the news on January 3rd, 2026, you saw one massive headline.
You couldn't miss it.
Nicolás Maduro, the Venezuelan strongman, captured. Regime change. I mean, for the Western powers, this was seen as a huge geopolitical victory.
It was the culmination of years of policy.
But today, we are going to go so much deeper than that headline. Because the real story, the one with truly seismic implications for the global financial system, it wasn't happening in Caracas.
No, it was happening in silence thousands of miles away, inside the vaults of the Bank of England.
And that's the pivot we really need to understand. While the world was focused on the politics, the moment Maduro was captured, the UK was suddenly facing this profound legal and financial dilemma.
And at the very heart of that dilemma was a single asset, a huge one.
We're talking about 31 metric tons of Venezuelan gold.
Exactly. And just to put a number on that for you, at today's market value, you're looking at $4.8 billion.
$4.8 billion. And this gold is physically secured, right? It's sitting in one of the safest vaults on Earth. But, and this is the key, it's completely inaccessible to the nation that actually owns it.
That's the paradox. It's what we've been calling Schrodinger's gold. It is, at the same time, both owned and not owned by Venezuela. It's trapped.
Trapped in a legal black hole.
A black hole created entirely by the political decisions of the country hosting the asset. It's essentially an asset hostage.
So our mission for this deep dive is to unpack the fallout from that decision to freeze the gold. Because this is not just a Venezuelan problem, is it?
Not at all. This is about the complete collapse of the global custody model, the fundamental trust that every central bank placed in the West to store its assets safely.
We're really looking at the exact inflection point. The moment nations around the world realized that safety, physical security from theft and sovereignty, which is unconditional access to your own wealth, have become mutually exclusive.
And that brings us to the core question. How did the Bank of England go from being, well, a neutral custodian, a simple safe deposit box, to becoming an active gatekeeper?
A gatekeeper that decides who gets their money based on political approval.
Exactly. And what does that mean for countries like China or India or Saudi Arabia? Nations that hold hundreds of billions of dollars in Western vaults? That's the question we're going to answer.
Okay, so let's start right there, in the immediate aftermath. You said the political events in Caracas created a legal nightmare in London. Walk us through it. The first 48 hours after January 3rd.
Right. So the news breaks, and you'd think the first calls would be about security or diplomacy, but they weren't. The response was immediate, and it was legal. It was calculated.
Because the Bank of England has a problem.
A huge one. Within hours, the UK Foreign Secretary Yvette Cooper is forced to put out a statement, and the pressure isn't from the UN or Washington, it's from the Bank of England's own lawyers. They need to know who has the authority to operate Venezuela's account.
So the key to the vault is actually the question of government recognition.
That's it, precisely. Cooper's office issues a very carefully worded statement. It says the UK will maintain a position of non-recognition of any new leadership.
Any new leadership.
Yes. Until, and I'm quoting here, stability and democratic legitimacy are formally established in Venezuela.
Now, on the surface, that sounds, well, it sounds prudent. Diplomatic.
Yeah.
A responsible wait-and-see approach.
It sounds perfectly reasonable. But in the language of central bank finance, the practical translation of that phrase is brutal and effective.
Which is?
The gold stays frozen indefinitely.
Indefinitely. Why is that wording so powerful?
Because stability and democratic legitimacy are not easily defined metrics. They're subjective. They can take months, years, maybe a decade to satisfy. Or maybe they're never satisfied, from London's point of view.
So it buys the UK government an unlimited amount of time.
Exactly. And while it's buying time, it completely neutralizes that $4.8 billion asset.
So when we say neutralize, what does that practically mean for Venezuela, no matter who's in charge?
It means they lose every function of ownership except the name on the account. They can't request a withdrawal, obviously.
Right.
They can't sell the gold. And this is critical because London is the global market for gold. That's where you get the best price, the most liquidity. So that's gone.
And what about using it as collateral? If a new legitimate government comes in and needs to rebuild the country?
They can't. That's maybe the most damaging part. They can't take this massive asset, post it as collateral for an emergency loan, and inject cash into their economy. The asset is a ghost. It's on the books, but it has zero economic function.
And it's so important to stress that London was ready for this. This wasn't some panicked ad hoc decision in 2026. This was them defaulting to a legal precedent they had already built.
Yes, the precedent from 2019, that's really the original sin here. Back then, the UK recognized the opposition leader, Juan Guaidó, as the interim president.
And the Maduro government tried to get their gold out.
They did, and the Bank of England refused. They said, sorry, our government recognizes Mr. Guaidó.
So Maduro's central bank sued the Bank of England in a British court. What happened?
They lost. The courts ruled that they had to defer to the UK government's political decision on who it recognized. The legal battle was, it was incredibly long. It dragged on for years.
And in the end?
In the end, Guaidó's political star faded completely. But the crucial point is, the gold never moved. The court case established the principle: the political will of the UK government overrides the withdrawal request of the depositor. It cemented the idea that your custody is conditional.
So in 2026, when Maduro is captured, it just creates a new vacuum of recognition. But the legal machinery to freeze the assets was already tested, it was oiled, and it was proven to be unchallengeable in court.
That's it perfectly. They just fall back to the safest legal position, which is freeze everything. Since there's no immediate, universally recognized successor, the lack of clarity becomes the justification for an indefinite freeze.
And the expectation is that clarity could take a decade.
Or longer. Our sources in the legal world say it might never arrive, which forces any future Venezuelan government to spend years and millions of dollars just fighting for access to wealth that is, on paper, already theirs.
This really shines a light on a concept that I think is terrifying central bankers everywhere right now: custody risk.
Yes.
We all know what physical risk is. Someone tries to rob the vault, Ocean's 11 style. But define custody risk in this context.
Custody risk has nothing to do with physical safety. The Bank of England's vault is probably one of the most secure rooms on the planet. Custody risk is the danger that your wealth, even though it's physically safe, becomes legally inaccessible.
Inaccessible because of politics.
Because of political mechanisms, legal injunctions, or regulatory actions taken by the host country. Venezuela is the ultimate proof that this is not some hypothetical line item on a risk assessment spreadsheet. It is a real active vulnerability. It's a weapon. You have the title, but you have absolutely no control.
Okay, let's drill down into the mechanism here. Because this isn't a bug in the system, it's a feature. It's built into the agreements themselves.
It absolutely is. When any central bank, whether it's Germany or Ghana, deposits gold in London or New York, the core legal foundation of that agreement is that it's governed by the laws of the host country.
So, you store in London, you play by British rules.
And you're subject to British courts, which sounds fine, it sounds stable. But it means the ultimate power over your asset rests with the foreign government whose laws you've agreed to be bound by.
And buried deep inside those agreements is what our source material calls the weaponized clause.
This is the fuse. It's the key to the whole mechanism. The Bank of England's standard custody agreement gives it the right to refuse a withdrawal if there is, and I'm quoting again, uncertainty regarding the authority of the requesting party.
Which, again, sounds reasonable. You'd think that's there to stop, say, a rogue employee from trying to steal the gold.
That's how it's presented. A simple due diligence anti-fraud measure. But in practice, it has been transformed into something far more powerful.
It's become a political determination dressed in legal language.
That's the perfect phrase for it. The Bank of England is a state institution. It takes its guidance on foreign affairs directly from the UK Foreign Office. So when the government says, we don't recognize the people asking for the gold, that automatically triggers the uncertainty clause.
And the freeze becomes legally justified under the terms of the agreement.
It creates a perfect, unbreakable legal circuit. And this is where the courts become completely powerless, which is the part that I think is just so shocking to so many observers.
Let's talk about that. Introduce us to this legal concept, the political question doctrine.
This is the steel trap. The political question doctrine is a long-standing principle in British law that says the courts must defer to the judgment of the executive branch, the government, on matters of foreign relations.
And recognizing a foreign government is the classic example of a foreign relations matter.
It is the textbook definition of an executive political act. So Venezuela's lawyers can show up in court with stacks of evidence proving their claimant has de facto control of the country, controls the military, the treasury.
It doesn't matter.
It doesn't matter. The judge has to say, I cannot legally question the Foreign Office's political decision. They are structurally barred from it. The political decision is treated as a fact, and that fact becomes legally unappealable. The asset is trapped.
And this is what leads to the term you used earlier, Sovereign erasure. Let's break that down with an analogy.
Sovereign erasure is when the legal reality of your ownership is erased by the political reality of non-recognition. So imagine you own a house, you have the deed, the title, it's 100% yours.
Okay.
But the local city council passes a resolution saying there's uncertainty about who's in charge of your neighborhood association. And based on that, they legally bar you from entering your house, from selling it, from renting it out, or even borrowing against its value.
The house is still mine on paper.
It's yours on paper, but its substance, its entire economic function and your control over it has been eliminated. It's been erased by a political mandate from the jurisdiction where it's located.
That is a sophisticated way to neutralize an asset without technically stealing it.
It is a legal neutering. It's immobilization as a weapon. And it represents this profound historical shift in what custody even means.
From neutral caretaker to conditional gatekeepers.
For centuries, the entire sales pitch of the Bank of England was physical security and political neutrality. Nations stored gold there because London was stable, the rule of law was strong, and you assumed apolitical professional management.
Your gold was safe, no matter what happened back home.
The assumption was, if my government survives the crisis, the gold is ours. But now, in the 21st century, that's over. Custody has been weaponized. The Bank of England is no longer just a secure storage unit, it's an active gatekeeper, and the price of admission is alignment with the geopolitical interests of the UK government.
So the historical promise of safe, apolitical custody
Is dead. It is completely and definitively dead.
Yeah.
And every single central banker on the planet knows it now.
That shift, it didn't just happen in 2019 or 2026. This is the end point of a very long escalation, isn't it? Almost a century of financial warfare evolving.
It is. You have to trace the timeline to really understand the gravity of this moment. And you can argue it starts as far back as 1933.
With FDR and Executive Order 6102.
Right. Now, that order was about forcing American citizens to turn in their private gold to the Federal Reserve. It was a domestic policy to fight the Great Depression.
So how does that connect to foreign central banks? They didn't seize foreign gold.
They didn't, but what it did was establish a critical legal precedent that the U.S. government, in a declared national emergency, could exert absolute unilateral control over any and all gold held within its borders.
It was the first modern warning shot.
It was. It sent a clear message that access to your assets in the U.S. is not a fundamental right. It's a privilege, and it's subordinate to U.S. national security or economic policy, as defined by whoever's in the White House.
Okay, so that's the first step. The next giant leap forward is 1971, the Nixon shock. This was a much more direct blow to the international system.
This was a profound betrayal of trust. You could argue it was the single most damaging event for the U.S. dollar's credibility until the Russian freeze in 2022.
Remind us of the promise that Nixon broke.
The post-World War II Bretton Woods system was built on a simple guarantee. Foreign central banks could exchange their U.S. dollar reserves for physical gold at a fixed rate, $35 an ounce. That promise was the bedrock of global finance.
It's what made the dollar as good as gold.
Literally. But as U.S. inflation rose and countries like France started asking for their gold, Nixon faced a choice.
And he chose to default on the promise.
He unilaterally closed the gold window. He went on TV and essentially told the world, we're not going to honor that convertibility agreement anymore. The asset they held, dollars, was still theirs, but its core function, its guaranteed value, was redefined overnight by the host country to serve its own interests.
So the rules can be changed at any time.
The host country can and will change the rules without warning. That was the lesson of 1971.
Which brings us to the massive escalation of 2022, the freezing of Russia's foreign reserves. You've called this the nuclear option. Why?
Because it vaporized the last shred of protection for central bank assets. There was a long-held tradition, almost a sacred rule, of sovereign immunity. You didn't seize another country's central bank reserves, even in wartime.
But the West did. Over $300 billion.
In a coordinated action, they froze over $300 billion worth of Russia's reserves held in dollars, euros, and other Western currencies. This sent a shockwave through the system. It signaled that all central bank reserves held in the West were now conditional.
Conditional on what?
Conditional on your political alignment with Washington and Brussels. If you fall out of favor, your nation's savings can be turned off like a light switch. China, India, Saudi Arabia. They all watch this and realize, if it can happen to a nuclear power like Russia, it can happen to anyone.
And that leads us right up to today, January 2026, the second Venezuelan gold freeze. You say this is the evolution complete. How is this even more significant than the huge Russian freeze?
It's about the lowering of the threshold. The Russian freeze, as shocking as it was, happened in the context of a full-scale war. It was part of a massive, unprecedented sanctions regime. The geopolitical context was extreme,
Okay.
but the Venezuelan freeze of 2026, it's happening during peacetime. The UK isn't at war with Venezuela. There isn't some new all-encompassing sanctions package driving this.
The asset is being frozen simply because.
Simply because the host country, the UK, disapproves of the political uncertainty in Caracas. The trigger for seizure has dropped from waging a major war to just having an internal leadership dispute that we don't like.
That makes the risk universal.
It makes it ubiquitous. It proves that financial weaponization is no longer a tool of last resort for extreme conflicts. It's now a standard, low-threshold instrument of foreign policy. And for the other 67 countries with gold in London, that is a terrifying realization. Any domestic political turmoil could instantly cost them access to billions of their own money.
So given this pattern, 1971, 2022, and now this even lower bar in 2026, what is the data telling us? Are central banks just accepting this new reality, or are they voting with their feet?
They are voting with their feet, that decisively but also very quietly. You have to remember, 68 countries store gold in London. That's about 5,134 metric tons, worth around $300 billion.
And they're all watching Venezuela.
Every single one of them is running risk models based on this precedent. And their most powerful response has been what we call the onshore shift.
Bringing the gold home.
Exactly. The data is just incredibly stark. If you go back to 2020, about 50% of central banks were comfortable keeping their gold offshore in places like London or New York. They liked the low cost and the high liquidity.
And now?
By the end of 2025, that number had flipped. 68% of central banks now keep their gold onshore, in their own vaults. This isn't just a market trend. This is a rapid, deliberate, and very expensive strategic pivot away from the West.
Let's put some hard numbers on that exodus, because the scale of it is pretty shocking.
It really is. Between 2020 and 2025, in just that 5-year window, about 1,100 metric tons of gold was repatriated. That's worth roughly $89 billion.
And how did that impact the big custodians? The Bank of England, the New York Fed?
They've seen a steady drain. The Bank of England's holdings fell by 15% from their peak in 2018. The New York Fed saw a similar drop, about 16%. These institutions that were once seen as the absolute bedrock of global finance are seeing their client base systematically walk away because of political risk.
And the specific examples, the countries doing the moving, are so telling. Let's start with Germany. They were early movers.
Germany was foundational. They finished the repatriation of 674 tons from New York and Paris back in 2017. And their justification at the time was so prescient.
What do they say?
The Bundesbank said that gold should be held where they can be accessed without restriction. That phrase, without restriction, that's the whole ballgame. They understood even then that access was the real issue, not just physical safety.
Poland was even more blunt about it.
Yes, in 2019, Poland brought home 100 tons from London, and their central bank governor stated it plainly. He said, "Gold stored abroad is not available in times of crisis."
Wow.
It's a direct link. The physical location determines its utility in an emergency. If war breaks out, sanctions hit, or you have political instability, they know now that your offshore assets are the first thing to be taken hostage. Turkey followed the same logic, moving 220 tons from the U.S. to Ankara.
And then there's India, a huge non-aligned power. How did the Venezuelan case specifically impact their thinking?
India's move in 2024 to bring back 100 metric tons from the Bank of England was a direct response to watching the Venezuelan legal saga unfold. Indian officials we've seen quoted privately said the move was driven by geopolitical risk
And a loss of faith in the law.
a loss of faith that international law would protect them. They concluded that if a political conflict arose between India and the UK, their legal protections would be subordinate to the political decisions made in London. They saw Venezuela as the canary in the coal mine.
This has to have completely flipped the old economic calculus. It used to be cheaper to store offshore.
It did. The old calculus was simple. Offshore was better. You paid relatively low vault fees, maybe a few million a year, and you had instant access to the world's deepest, most liquid market in London.
But the new calculus has to account for this new risk.
The new calculus is all about risk. Yes, building your own state-of-the-art vault is expensive. It's a massive upfront cost, maybe $50 to $200 million. But then you compare that $200 million investment
To the $4.8 billion that Venezuela has lost access to indefinitely.
Exactly. The cost of repatriation becomes a one-time insurance premium against total asset immobilization. Sovereignty now has a clear price tag, and it outweighs the benefits of liquidity and lower fees. The cost of sovereign erasure is now the number one factor in every reserve manager's mind.
The public statements are diplomatic, but the private surveys must be showing the real fear.
The 2025 World Gold Council survey is where you see the unvarnished truth. 73% of central bankers cited geopolitical risk as a top concern. 68% specifically cited custody risk. 54% said they lacked confidence in offshore legal frameworks.
And there was one quote that just summed it all up.
The quote from the Turkish central bank official is just so blunt. He said, "If the gold isn't in Turkey, it's not really ours." That sentiment right there defines the entire new era of global finance. Physical possession is now the only true guarantee of ownership.
So the thing that really stands out here is that this crisis of confidence, it can't just be contained to gold bars in a vault. The principle at stake here seems to apply to the entire financial system.
That's the contagion. This is why you, listening at home, should care deeply about what happened to Venezuela's gold, even if you don't own any.
Explain that connection.
The entire post-war financial system was built on one fundamental assumption, that the rule of law in Western countries was neutral and inviolable, that you could store assets there, and the legal system would protect your property rights regardless of politics.
And that trust is now broken.
It's gone. The legal and political mechanism that was used to freeze Venezuela's gold applies equally to stocks, bonds, intellectual property, corporate bank accounts, anything held in those jurisdictions. The message being sent is that all property rights are now conditional on your political alignment with the West.
So are we seeing this contagion effect in the hard data beyond just gold moving?
Yeah.
Is real capital starting to avoid the West?
We are. The most direct measure is foreign direct investment, or FDI. FDI into both the US and the UK dropped by 12% in 2024. That was the first decline in over a decade.
And analysts are connecting this to custody risk.
They're pointing to it directly as the main non-economic driver. The question becomes, why would you build a billion-dollar factory in a country that could legally trap your asset if a political dispute arises? The risk is no longer theoretical.
Okay, so let's get to the biggest asset of all, the one that underpins the entire system, the US dollar and US Treasury bonds.
This is the ultimate long-term vulnerability for the United States. If central banks are nervous about their gold in London, you have to assume they are terrified about their dollar holdings.
And we're seeing them act on that fear. There's been a significant sell-off.
A huge one. In 2024 alone, foreign central banks reduced their holdings of U.S. Treasury bonds by $217 billion. These are not minor portfolio adjustments. This is strategic de-risking.
Who are the major sellers?
China is the biggest, reducing its holdings by $87 billion. But what's really telling is that it's not just adversaries. Japan, a key U.S. ally, reduced its holdings by $52 billion. Saudi Arabia cut its exposure by $38 billion.
So even allies are hedging their bets.
They are all diversifying away from the dollar because they saw what happened to Russia's reserves. They recognize that in a geopolitical fight, those T-bonds instantly become financial hostages.
And this selling creates what the source material calls the doom loop. Can you walk us through how that works step by step?
The doom loop starts with this loss of trust. Foreign countries see the political risk of holding U.S. assets, so they start selling their T-bonds.
Stick one, demand for U.S. debt falls.
Right. Step two, to attract new buyers and finance its own government spending, the U.S. Treasury is forced to offer higher interest rates on its bonds.
So it becomes more expensive for the U.S. government to borrow money.
Exactly. And that's step three. Higher government borrowing costs feed directly into the commercial economy. Mortgage rates go up. Car loans get more expensive. Corporate borrowing costs rise. It slows down the entire economy.
So the short-term power move of freezing assets has a long-term cost for the average American.
A massive one. The U.S. gets this incredible short-term leverage, but the long-term price is the slow erosion of the dollar's global status, which in turn means higher borrowing costs for everyone in the U.S. It undermines the very system that gives the U.S. its exorbitant privilege.
It's a fascinating paradox. Every time the West uses this financial weapon successfully, it gives every other country a powerful incentive to build a shield.
It's a classic case of imperial overreach. The weapon is so powerful and so tempting to use that its very use guarantees its eventual obsolescence. You're teaching your opponents how to live without you.
So here we are, January 2026. The trust is broken, the exodus is accelerating. You mentioned that 3 more central banks have already started repatriation processes just in the last few weeks.
That's right. The cascade is beginning.
What happens if this quiet, orderly withdrawal turns into a stampede? This raises the possibility of a geopolitical run on the bank.
That is the absolute nightmare scenario for both the Bank of England and the New York Fed. If, say, half of their 68 sovereign clients all demanded their gold back at the same time, the system would break.
Because we're not talking about a wire transfer. This is a massive, physical, logistical challenge.
It's incredibly complex. Moving gold is not instantaneous. First, every single bar has to be checked against the records. It has to be weighed, assayed for purity. That alone takes a huge amount of time.
And then you have to actually move it.
Then you have to arrange secure transport. Armored trucks, specialized air freight, multi-billion-dollar insurance policies that have to be underwritten. The logistics are staggering.
So realistically, how much gold can the Bank of England move in a month?
At full capacity, without completely disrupting the market, they can probably facilitate a few hundred tons a month. If the demand suddenly spiked to, say, 1,000 tons simultaneously, you'd have a queue.
And a queue creates panic.
A queue creates panic. Every country stuck in that line would start to worry they might be last. It would compound the political crisis of trust with an operational crisis of confidence.
So what are the triggers? What could push us from this manageable slowly phase into that catastrophic suddenly phase?
I see 3 main triggers. The first, and maybe the most dangerous, is if another major country's assets get frozen. Imagine a trade dispute with Saudi Arabia and the US or UK decides to temporarily freeze their assets as leverage.
The message would be that no one is safe.
The stampede would be immediate. It would prove the threshold for seizure is now dangerously low and can be applied to anyone, not just pariah states.
Okay, what's the second trigger?
The second would be a major player announcing full repatriation. Not just a portion, but everything. If China or India were to publicly state, we are bringing all remaining assets home from London and New York, that would be a watershed moment.
A definitive vote of no confidence.
It would be a geopolitical earthquake. Other nations would see that as the definitive signal that the system is broken, and they would rush to follow.
And the third trigger is actually the Venezuelan situation itself.
Yes. If this freeze just drags on, say we get to 2031, and that gold is still stuck in London, that's more than a decade since the first freeze. That would prove that this risk is permanent.
It's not a temporary problem you can solve with lawyers.
It proves that the assets are subject to permanent political capture by the host nation. And that would be the final piece of evidence every central bank needs to justify getting out completely.
So as this new architecture takes shape, where is the money and the gold going? What are the real alternatives?
There are 3 main paths emerging. The first and the simplest is pure repatriation, bringing it all home. That's the German and Polish model. You get the highest possible sovereignty, guaranteed control.
But it's expensive and you lose liquidity.
Right. The second option is the rise of alternative custody centers. Places like Singapore, Dubai, and Zurich are marketing themselves aggressively as the new Switzerland, politically neutral, secure hubs.
They offer the vaults without the political baggage.
That's the sales pitch. But their long-term neutrality is untested. If the U.S. put extreme pressure on Singapore, would they really hold firm? That's the billion-dollar question.
And the final option.
The most cautious approach. Distributed custody. Don't put all your eggs in one basket. Keep some gold at home for sovereignty, keep some in London for liquidity, and maybe put some in Dubai as a hedge. It's more complex, more expensive, but it mitigates any single point of failure.
So if you had to make a forecast looking out over the next 10 years, what's the most likely scenario?
The most likely outcome, I'd say there's a 50% probability, is what we call the muddle-through scenario. The Venezuelan gold is eventually returned, but only after a long, damaging fight that takes 5 to 10 years.
But by then, the global financial map has been redrawn.
Permanently. By 2035, we'll see 30 to 40% of all gold repatriated from London and New York. The dollar share of global reserves will fall into the 40 to 45% range. We'll be living in a financially multipolar world with distinct economic blocks, a Western bloc and an Eastern bloc, and the unified, dollar-dominated system of the 20th century will be a thing of the past. Hashtag, outro, the final takeaway.
When you put it all together, the story of this Venezuelan gold is so much more than a $4.8 billion dispute. It's really a historical marker.
It marks the death of the trust that held up the entire post-World War II financial system. The trust that promised your property was safe, that custody was neutral, that the rule of law was separate from politics.
And that illusion is now gone.
It is completely and definitively dead. The chilling lesson from January 2026 is that custody without sovereignty isn't really custody at all. It's just political leverage waiting to be used.
And the mechanism that was used on Venezuela can be applied to any nation that falls out of political favor.
Or even one that just has too much internal political noise.
Which brings this entire global story right back home, to you, the listener. Because if a sovereign nation with armies of lawyers and trillions in assets can't trust the system, what does that mean for your assets?
This whole saga is probably the single most powerful, real-world argument for the value proposition of decentralized, trustless systems. If centralized custody is now a proven weapon of political warfare, then trustless custody, where you and only you hold the keys, becomes more than just an investment thesis. It becomes a strategic imperative.
So the final question we want to leave you with is this. In a world where financial systems are now demonstrably weapons, where the rule of law has been shown to be conditional, where do you store your wealth? And what price are you willing to pay, in cost, in convenience, in complexity, for real, unchallengeable control? Venezuela's loss has shown us the price of not having sovereignty is $4.8 billion, and counting. Your mission is to figure out what your financial sovereignty is worth to you.